December this year, we mark the 5-year anniversary of PEIC's listing on the ASX. As we approach this milestone, I would like to take this opportunity to pay thanks to the many shareholders that have supported PEIC since our inception. In addition, I would like to welcome all the new shareholders, with a number of new shareholders participating in the capital raising that the company undertook in financial year 19. PEIC has continued to focus on delivering the investment objective set back in 2014 to provide investors with a growing income stream and long-term capital growth over a minimum 5-year period through a portfolio of high-quality Australian and global listed securities. Excuse me. PEIC offers shareholders the opportunity to invest in an actively managed portfolio with access to the deep investment management experience and expertise of the Perpetual Equities team. PEIC is managed by one of Australia's most experienced and respected fund managers, Perpetual Investment Management Limited, which has been investing in Australian listed securities for more than 50 years. The investment approach and philosophy underpinning PEIC focuses on value investing and takes a disciplined and bottomed-up approach to finding quality stocks trading at attractive valuations. Whilst the manager's investment process has been challenged with elevated company valuations resulting in opportunities becoming more scarce, we remain confident in the manager's ability to actively navigate markets and invest shareholders' capital prudently to assist in preserving value in these conditions. For the 2019 financial year, PEIC delivered a solid operating profit after tax of $15.2 million. The board was pleased to declare a fully franked final dividend of 3.4 cents per share, bringing our total dividends declared for FY19 to 6.5 cents per share, fully franked. This represents a very attractive annual grossed-up dividend yield of 8.8%. We recognize our shareholders value a strong and sustainable fully franked dividend stream, and we are pleased to provide this consistent result to our shareholders. Let us now touch on our capital raising. We received a very strong response from investors, raising $101.2 million. The proceeds from the capital raising have been used to support the company in expanding its portfolio and to take advantage of market opportunities as they arose. The capital raising successfully helped increase the depth and liquidity for shareholders, with the total number of PEIC shareholders increasing by 20% and the total volume of shares traded increasing by 10% during FY19. In addition, with the scale benefits achieved from the capital raising, we have seen a reduction in the company's total management costs of approximately 15 basis points. We acknowledge that the company's share price and investment performance has been disappointing, and that a discount between the share price and the pre-tax net tangible assets has emerged. For those of you who have been shareholders for some time, you would be aware that the company has previously traded at a discount, and that in the past this has reverted to a premium over time. The board believes there are 3 key drivers which support the share price to trade in line with the NTA. The first is the company's dividend strategy, the second, the investment performance, and thirdly, shareholder engagement. As your board, we will continue to focus on these drivers to close the NTA gap. I would like to highlight the governance PEIC has in place to monitor the manager and other key service providers. The board is made up of 5 directors, including 3 independent directors with expertise across financial services, regulation, and risk management. The board undertakes rigorous governance processes throughout the year to ensure shareholders' money is being appropriately managed. This includes monitoring and reviewing the operations of the manager, Link Market Services as the registry provider, and RBC, who is your custodian. The board actively challenges the manager on your behalf to ensure appropriate investment opportunities are pursued and adequate resources are deployed. The manager is required to report to the board regularly on investment performance and the composition of the portfolio. During FY19, we conducted a survey, first time we've done this, of all of our shareholders to gather feedback on what is important to you and understand what we can do to enhance the value we provide and the services we offer. We had a great response with more than 1,000 shareholders participating. Thank you to everyone who took the time to complete the survey. Some findings from the survey include 85% of you indicated franking credits were critical or important. More than 70% said you were seeking both capital growth and dividend income. And many, over 60%, are interested in receiving information on PEIC's performance and the companies we invest in. You may have already noticed we have started to use this information to enhance the insights in PEIC's monthly investment report and the NTA report. We know how important it is to our shareholders that we are transparent and understand the importance of keeping shareholders informed. From our shareholder survey, we found that a low number of shareholders are actually accessing the website on a regular basis. I strongly encourage you to visit the website, as there is a lot of information there that will help keep you informed, including the monthly report, the daily NTA, and a deep dive into the stocks that we own. Finally, I would like to reassure fellow shareholders the board will continue to prudently and responsibly manage your company. Thank you for your ongoing support and interest in PEIC. At this point, I would like to hand over to the manager, Vince Pezzullo, to provide a market update.
Good afternoon, everyone. Today I thought I'd start with just a review of the markets and what some of the observations we've seen in the last 9 months in the behaviour in markets. It's been quite extraordinary what we're seeing globally, particularly on a macro basis. And then I might do a deep dive into one of our biggest positions we have in the PEIC, which is called Flutter Corporation, and just walk through how we think about the stock, how we arrived at the answer as to why we have a large position in it, and the prospects for the company, and how we value it. Valuation's quite a difficult thing to do with companies that are growing a bit quickly, so I'll walk you through that. And then we're going to invite Nick up to the stage. Nick's going to walk through something which is quite topical, which is the prospect in Australia, I would never thought I would hear this, of negative interest rates potentially, or quantitative easing. And Nick's going to talk about what that means for banks and deposits, etc. And then we'll just cover off on the performance and just some of the new names we've added to the portfolio over the last basically 12 months. Okay. So the last 9 months in particular, 12 months, macro policies played quite a bit of havoc with markets. Last year, if you think about the setup, the Fed was talking about the end of the easing cycle. They were raising rates. They were talking about actively this thing called quantitative tightening, i.e. shrinking their balance sheet, stop buying treasuries, etc. So pull liquidity out of the system. That was all happening last year. You had a tremendous run into January last year, and the Fed was pretty strident about, we are not going to change our mind. You fast forward to probably about October last year, and things started to change. Some of the early macro signals, there were some early macro indicators such as weakening Europe, obviously an impact from the trade war with Chinese export data collapsing quite quickly. Europe being a bloc which exports quite a bit of its trade, given they are mercantilists, into China. It started hurting Europe. You started seeing some of the commercial lending data in the US starting to weaken. Maybe it's a second order impact of what happened because of the trade war. Companies were getting a lot less confident about where they invest, so you tend to pull back when you do that. And some consumer credit weakness as well in Europe in particular. So what did that cause? That caused what we've been used to for prior to basically last year, which is this rotation back into yield. Remember, yield at any price. And buying companies with very certain earnings and or growing earnings. And growing earnings at any price. You didn't care what you paid for the company. As long as it was structurally growing, I don't want to be exposed to, basically the rest of the market was suggesting, I don't want to be exposed to anything that's cyclical. The earnings can go down based on activity. So that revived this yield trade, momentum trade basically, which is occurring from 2016 onwards when QE4 effectively kicked off. But what we've noticed in September, month and a half ago, or starting a month and a half ago, was a rotation back into more cyclical names or names where the fundamentals weren't being matched by the price you're paying, i.e. the price is a lot cheaper than the fundamentals you're paying for. And you might have seen more importantly, and this is always the canary in the coal mine, was you started noticing that some of these tech IPOs were starting to either be pulled or falling 30 to 40% on day one. Now, when you're buying companies in particular that don't make any money, it is technically a greater fool trade. You're hoping someone will pay a little bit more than you because if you're basing it on the fundamentals of the company, i.e. we make no profit, but we're growing revenue, but we make no profit, there is literally a trapdoor under you. At any point, it could go from underneath you. And just to leave you, I mentioned this earlier, if you think about the Russell 2000 is the small cap index of the US, okay? In the last 12 months, 20% of the listed companies on the Russell 2000 make no money. Right? And that's with some reasonably good economic conditions. You know, very lower rates or reasonable rates. GDP growth in the US is close to 3.5%, etc. And these companies were making no money. And then when you look at the IPOs that have come to market in the last 12 months, 80% of them make no money at all. So if you're not making money when you're unlisted, good luck making money when you're listed. All right? Because firstly, we know this for a fact, your governance costs are going up. You're going to have to audit it properly. So these are these aspects where the markets are in this position of suspension of disbelief. If a company is making no money at some point in the future, it will. And you typically need very low rates for that to happen because your alternative of return is I don't get a lot in the bank, so I'm forced into other assets. And what's been happening as rates globally have been going down, thank you. As rates have globally been going down and we've got negative rates, you know, $14 trillion of negative rates globally, people are going up the risk curve. You know, my perception is when rates go negative, you go down the risk curve because that means something's not really right in the economy globally. You should be going the opposite direction. And to that point, I talked about September, there was a major rotation out of growth stocks into value stocks. And to that point, you saw there some of the favourites, Appen, Pro Medicus, Nanosonics. These are stocks that are trading on 30, 40, 50, 100 times. Within the space of 2 weeks, fell 30%, 20, 30, 40%. But stocks, good old stocks, that have hard assets, trading on multiples of 12 times PE, pay a 4.5% dividend yield, quite conservative, were up 20, 30% in that period. That was a little snippet as to what can happen if rotation begins. That people start saying, you know what, I'm paying way too much for this business. I'm paying 100 times PE. I'm not going to be around that long. Or growth has to genuinely reflect the multiple. So, you know, investors need to be very cognizant of the embedded risks in your portfolio. Now, there are some great companies that you've paid a high multiple 10, 15 years ago and they're still on a high multiple. CSL is a perfect example. Great company, an icon of Australian business. It's traded from between 20 times PE to 18 times PE back in the day. Now it's trading on about 36, 37 times. It is growing though. It's still growing its earnings by about 15% a year. A great business. But at 35 to 37 times, we tend to struggle with that because we think there's other things on offer, like an Origin. We own Origin and we own Fletcher Building in our portfolio. So it is very important to understand this thing when we talk about rotation. Because if you look at the type of stocks that people own and the viciousness of some of the sell-offs, is people are relying on, why did this happen? Why did these tech stocks or high multiple stocks fall all of a sudden? And it was basically because there was the prospect that rates may actually go back up again. That was it. You know, there was some confidence that maybe there was a trade deal about to be done. And you could see it in US yield curves, etc. They started to steepen. So that means people are expecting higher inflation in the future. And if you've got a long duration company or a company on a high PE and rates go up, you're going down. Your multiple's going down. So that's all it took, was a change of perception. But what it tells you is the investors that are willing to accept a certain dividend yield or a company that's guaranteed to grow and willing to pay 40 or 100 times, they're hanging on to one thing, which is rates have to stay low pretty much forever for me to get paid. We're of the view that you don't need to do that. You want to assume that things mean revert at some point, that rates will go up, and that if the portfolio we own today, we're paying well below the fundamental value, we're happy to wait at this point. Now, the chart on the screen at the moment is, this represents our quality universe. It's not our portfolio, it's the quality universe. So I'll talk about our 4 quality filters at some point later on. But there's about 300 odd companies in our quality universe. This is what I can choose from. This is our set universe, what I can choose from to put in our portfolio. Okay. Now, all the companies, there are several 2,000 odd companies you can invest in. Now, all those companies have to go through a quality filter, which I'll talk about later. And of those that qualify to go into our quality universe, this represents the performance of, if you just bought every company in our quality universe, there's 300 odd, that's the performance you would have got above or below the market through the last 20 odd years. Now, fortunately, the net number above is greater than the net number below. But what it does show you is, and you can see in the period leading up to 2007, where there was you could describe as a mania developing, we didn't particularly perform well because companies, you were having to pay well above the intrinsic value of a company, and again, suspend disbelief that I'll get paid in the future. Now, you can see that the snapback in performance after those extreme periods was pretty extreme at that point. And now, the last 3 years, you can see the performances of just the universe itself has struggled a bit, in particular in the last 12 months. And that is, again, back to what I would call extreme macro conditions, where we've gone from steadily rising rates to steadily cutting rates and potentially talking about QE again within the space of 12 months. That's really important because if you think about when the central banks used QE last time, we almost had the collapse of the financial system for them to be goaded into doing it. Now, to do QE today, you just need a little bit of weak growth, right? Which is technically what we consider to be a simple inventory cycle. So the system built up too much inventory, companies got too bullish at the top, they ran their plants at 100%, they're sitting on a lot of inventory, you had a little bit of weak growth globally, and they've got inventory in the warehouse. So now they're not running as many shifts, they've got the inventory, they'll just sell the inventory into the market, so activity slows a bit. That's what it is. That's what we're going through right now. The financial system's pretty robust. But central banks are thinking about, let's just do QE again. Well, what it suggests to me is that monetary policy is probably at the end of the rope, that its effectiveness is much less than it was. So you either bring a bigger bazooka to get the thing to move again, and then you develop unintended consequences in the system, which is, in this cycle at the moment, corporate leverage is extremely high. Okay. The last cycle was consumer leverage, was very high. In this cycle, we've got very large corporate leverage. And that most of the corporate leverage which has been generated, most of that borrowing has gone to do buybacks. I'll just quickly just touch on some of the contributors and detractors. I'll highlight just a few names, 3 names. So Select Harvest was a big contributor last year, an almond farming group in Australia. We like them because the company invests for the future. They invested a lot of equipment for defrosting the crop so there wouldn't be a frost. That paid off. You had a trade war which benefited Select Harvest as well because California is the largest almond growing region in the world. The Chinese were buying a lot from the Californians. Trade war sort of helped the Australians out there. And now I suspect some will go back to California when that happens, but I think the Chinese will probably defray the risk of being reliant on one supplier. Takeda, that was Shire. Remember, we had a very large position in Shire. It was about 12% of the PEIC. That transaction consummated late last year, so went to terms, so went up to about £45 from £33, and we got paid for that. And lastly, Medibank Private, and I've talked about this quite a bit. Obviously, there's quite a bit of political risk in Medibank Private running into an election where the Labor Party was not as enthused about private insurance. And a lot of people aren't either, because you're paying for, it's a bit of a grudge purchase. But post the election, obviously, the coalition's thinking about trying how to improve the system. So it's better for a Medibank. And we still like Medibank. It's still a large key holding in our portfolio. You know, they are actually winning market share for the first time in 7 years. What detracted from us last year are Clydesdale, UK bank, spun out of National Australia Bank. They consummated a merger with Virgin Money in the UK. A couple of weeks after that, they updated the market and they pretty much downgraded immediately, which tells us that we were a bit, management was okay to us, but at that point, what made us realise that they hadn't done the due diligence on the transaction. We sold that immediately last year and it's fallen another 50% since then. And lastly, Bega Cheese, I'll just highlight that. We still own it, we quite like it. Again, there's a drought on, so the processors, like Fonterra and Saputo, and Bega is one of the large milk and cheese processors, they're competing for milk. There's a drought through all northern New South Wales into northern Victoria, so there's not a lot of milk going around. So the cost of the input, their inventory, is going up, while the international price maybe not keeping pace with that. So we still like Bega. We actually bought a little bit more when it fell to about $4. It's back up to about $4.60. You know, we like that sort of a business because it's idiosyncratic risk, so it's a risk only for that company that we're exposed to. So if the drought breaks, the stock's going higher, and it doesn't matter what the Australian economy is doing at the same time. So it's very uncorrelated to the rest of our portfolio. Now, I'll just briefly touch on, I talked about the quality universe before. This is the 4 quality filters. I just want to remind everyone what they are. So the quality business, we look at every company, we analyse the margins, the performance of the business, look at how competitive the underlying industry is it easy for capital to enter and exit the industry, etc. We have a very hard and fast rule about conservative debt. You know, 50% net debt to equity or 3 times EBIT interest cover for us. Any company that breaches those gets kicked out of the universe, and we sell, if we have a position, we sell immediately. And that may become very important in the next 12 months. Sound management, visit the company, understand how management makes decisions. Is the strategy right for the type of business they are? Let's understand how they'll behave when things get tough, because that's when all the hard decisions need to be made. And finally, I think it's important about the point I raised earlier about companies that are listing that don't make any money. We won't invest in a company that makes no profit. Okay, first of all, we like dividends, but recurring earnings shows a discipline of companies having to settle with quite a few stakeholders, etc. Shareholders, employees, government, regulators, etc. And that's why you won't find a company in our portfolio that doesn't make profit. So we'll be able to go through any sort of economic cycle and survive. All right, move on to Flutter. Now, what is Flutter? Flutter is it's a sports bet, gambling business, global business. It's a merger of Paddy Power and Betfair. It happened a couple of years ago. It's either the number 1 or number 2 operator in each of its markets. It's in the UK and Australia. People know what it is in Australia. It's sports bet in Australia. Okay, we consider them to be number 1 operator in Australia. And they operate on they're pretty much an online business. about 90% of the revenues come from online. It doesn't have a large retail footprint, the betting shops. There are 0 in Australia, have some in the UK. Sportsbet is a perfect example. It's entered the market and it's gone to effectively close to #1 market share in that period, competing against an incumbent in Tabcorp. Okay. That's given their experience and the quality of the business itself. The balance sheet for us is they've got virtually no debt. Okay, but when you look at the competitors they have globally, there are 3 odd competitors or more, a few more, one unlisted. GVC Group, the Stars Group, and William Hill. And all of them run with debt ratios of between 3 and 5 times EBITDA, so earnings, which is quite significant because EBITDA is before interest and all the important expenses like tax. So they're running very highly leveraged, whereas Flutter runs no debt effectively. So when it competes in market, it can be really aggressive because it'll survive, whereas its competitors might struggle. The reason we like Flutter is they've entered the US market. So what's happened approximately 18 months ago is in the US, if you want to put a bet on a sport, you had to go to Nevada effectively, or the black market, your phone betting account, so to speak. But that law got challenged and the Supreme Court ruled on it, and now you can, a lot of states in the US, because it is a state-by-state option, liberalising betting laws so that you can do either retail betting on sports or online betting and online casino actually in each jurisdiction, each state. And why we like Flutter is they bought a business in the US about 2 years ago, before the laws had actually changed, called FanDuel. Now what FanDuel is fantasy football. Does everyone know what that is? You do it for kudos basically. You pick your players you like from the thing about the NRL. You pick all your favourite players. You form a team, and you see how they rate versus another group during the week, and you win points, etc. You can't legally gamble on that. So in the US, they bought this FanDuel business for approximately $800 million US 2 years ago. They owned about approximately 80% of it, and they've got about 8 million customers on that already. Now, as sports betting has been deregulated in the US, they've got a ready-made group of customers already. And the first state to do outside of Nevada in the US is New Jersey. US, they liberalised first. And in that period of time, FanDuel, let's call it FanDuel, it's Flutter, has about 50% market share in New Jersey in the space of 12 months. Half of its players have come from from FanDuel, the Fantasy Football League. Now that's pretty important because it's a cheap way of accessing customers. More importantly though, the reason we like Flutter is globally they're in the UK, Australia, other smaller markets, and now the US. Flutter operates effectively a risk and trading book. With betting, it's all about pricing and liquidity. Okay, so that allows you to write risk and manage the risk of your bets. So they run their risk book out of Dublin and in Melbourne, in Australia. Now Flutter gets access to, FanDuel gets access to all that infrastructure. So they were actually able to enter the US market very quickly and grow very quickly. So why do we like it? So we feel the manager's probably the best in the sector, if you look at what they've been able to achieve. So in Australia, for a case in point, Flutter's or Sportsbet's EBITDA in Australia was flat last year. The reason it was flat was point of consumption tax was introduced in all states in Australia. So they took an earnings hit because of it. But if we exclude the tax hit, Sportsbet's earnings in Australia would have grown by about 60%. Right? So that's how good they are at managing their business, how to activate their customers, how to take market share, because they run a very low-cost model. And with FanDuel in the US, as I mentioned before, they're already at 40% market share in the US. Naturally, they run with about a 20% market share globally. They say, any market we enter, we can get about 20%. In New Jersey already, the first market to open up, they're already at 40 to 50%. which tells me they've already got an advantage. Now, we always assume they'll go back to their natural market share over time. Now, a couple of weeks ago, 2 weeks ago, they announced a merger with a company called the Stars Group. And the reason that's been allowed to occur is the Stars Group has fallen 50% in the last 12 months. Again, it's another gambling group globally. It has quite a bit of debt, right? That's one of the reasons it's fallen, is that it's got quite a bit of debt and they aren't able to compete in a new market like the US. And there was leverage concerns with the Stars Group because of the debt, but also management capability, because they haven't really executed as well as they should have. So because Flutter's balance sheet's been so good, the PE of the Stars Group was about 8 times PE. Flutter's at about 22 times, right? So they use their paper and they're buying effectively, rather than merging, they're buying the Stars Group. Now, what does it give them? It gives them it makes a lot of sense because Stars management and infrastructure, Flutter's management and infrastructure, you'll basically plug in the Stars Group's assets into that and leverage it up. And I'll go through some of the accretion numbers soon. So what do we think it's worth? As you can see there, I'm going to compare it pre-deal as Flutter is today. That's the numbers on the left-hand side, and versus post-deal, where if we assume they merge, the Stars Group and Flutter, what does it look like? We still like it because if you look into FY21, ex the US losses, because they're funding US, is still in losses at the moment because it is a new market. It's trading on about 17 times PE, which versus the average Australian industrial business, which trades on about 21 times, still looks pretty good to us. And it's still growing about 20-odd%, the earnings growth. And it pays about a 3% yield today. When we bought it, it was paying about a 4.5 to 5% yield. It's gone up about 40-odd% in that time. But to us, the post-deal metrics look very compelling. So if you look on the right-hand side there, the Flutter post-deal, in FY21, it's on about 11 times PE. Right, so an earnings yield, you think about invert that PE, you get an earnings yield of about 9.5%, 10%. Plus add the dividend, you're getting 12 to 13% sort of returns. And the debt, while high, not extremely high at 2.1 times, they'll pay, these businesses generate a lot of cash. But they're growing earnings by about 31% in that year, up to about, and into 22, about 13, 14, 15%. They've highlighted about £150 million of synergies. We think that's a bit light on, but we've factored in what the company's stated. Now, I just want to talk about the US opportunity for Flutter, because it's a brand new market, and valuing new markets is pretty difficult because there's one big thing there. There's a thing called assumptions, and I can guarantee you almost every number will be incorrect. But you've got to make a couple of assumptions to try and understand the scope of the business, what it could be, and then you tend to walk back from that number to get a bit of conservatism. Now, rather than us try and make the assumptions, Flutter actually had a capital markets day. So if you look at the box on the left-hand side, they presented that box in March this year. And what they said was they thought the whole US market would be 10x, you can see the number 10x, the size of the New Jersey market, which is the first market to open in the US. That came out with, now this is $6 billion, that's the size of the market, which is available to the operators. That's the revenue of the operators. And they assumed, Flutter assumed 20% market share. They'd get their 20% market share, which is equivalent to about $1.2 billion of revenue for them. They pay, bonuses to customers, for betting, etc. They put money in the account, etc. If you're a high bettor, of about $200 million. So you get a net revenue of $1 billion, and they have about a contribution margin of about 40%. So they're making about $600 million plus existing business revenues, earnings about $600 million, which is equivalent to the rest of Flutter's current business. That's what we're saying. The US market will probably be about the same size. So they reported a couple of weeks ago, and the box on the right-hand side, that's what's actually happening today. So at the moment, live today, 6.7% of the US population is available today that can bet. And it's worked out to be about 2.5 times the size of New Jersey, so it's about a $1.4 billion revenue market. But what's happened subsequently is there's another 12.2% of the US population, due to regulatory the deregulation, of other new states, so Ohio, Indiana, etc. They've all opened up as well because states love tax revenue. So there's approximately 18.9% of the US population now, which you can sell sports betting services, and that revenue is already at $4 billion. So they assume that at 100% of the US market, they'd be at $6 billion. They've only opened up to 20% of the market, it's already at 4. So we've underestimated it. We're all going to underestimate it, we feel, but there'll be more competition though. We're not assuming that Flutter will be at 40% market share. We're always assuming they're going to be at about probably 20%. And for us, that gives us about a number of about $350 million of earnings in the US. And they do about $450 out of the current business today, out of Australia and the UK. So for us, the way we value that is we get $350 million of EBITDA. We put it on about a 12 times multiple, okay, and you get about 3.3 odd billion, 3.5 billion of value, which is equivalent to about, at 80% ownership, about 33 pounds a share. The stock's currently trading at about 75 pounds a share. So, but that's out there, okay. These are, as I said, they're assumptions. There's quite a bit of forecasting error that could occur, but we've got a lot of confidence in the fact that if you look at what the management's done over the last 10 years, whenever they've entered a market, they've always been probably the best operator and they generate earnings, which is well above everyone's expectations. So now I'd like to invite Nick to the stage to walk you through this issue regarding negative interest rates.
Thank you, Vince. So my name is Nicholas Vidale. I'm an analyst within the Australian equities team at Perpetual. Today I'd like to spend some time talking to you about what the impact of low interest rates are on banks. But before we do that, I think it's very important to start by talking about what an interest rate actually is. So there are a lot of different ways to define an interest rate. The way I like to think about what an interest rate is it really should be a rate of return that compensates a lender of money that takes into account real economic growth, inflation, any risk specific to a particular borrower, and the length of time that money is borrowed for. The lender of money, or essentially the person who's been saving, is giving up their ability to spend today by lending to someone else with an expectation of being paid back more money in the future. By delaying their investment opportunity or consumption decisions today, they expect to be rewarded for this later on. So who sets interest rates? Central banks, which may or may not be independent from the government, determine the base interest rate within an economy. The base interest rate is used as a policy tool to target various economic objectives such as growth, inflation, and currency. The Reserve Bank of Australia is Australia's central bank and derives its functions and powers from the Reserve Bank Act 1959. Its duty is to contribute to the stability of currency, full employment, and the economic prosperity and welfare of the Australian people. This mandate forms the basis for setting interest rates under monetary policy in Australia. The policy interest rate is the interest rate which commercial banks borrow and deposit money with the central bank. Central banks cannot influence the rate banks are lending at. However, when central banks change the policy rate, they indirectly influence the lending rate by making it cheaper or more expensive for commercial banks to borrow from the central bank. So this policy rate influences the rate at which they can borrow and lend at the central bank or between each other in interbank markets. Now, as interest rates have fallen over time, central banks are being forced to use other policy tools to influence interest rates. This includes influencing medium-term expectations on interest rates through policy signalling, changing reserve requirements, which influences the quantity of money in the banking system, intervening directly in interbank markets through the buying and selling of bank debt, and quantitative easing, which we've been talking about this morning, which particularly since the 2008 and 2009 financial crisis is becoming an increasingly prevalent tool of managing interest rates across all durations of borrowing within the economy. This involves central banks buying and selling all types of investment-grade bonds using the balance sheet of a central bank to manipulate interest rates that we see in the economy. Now, interest rates remain low because global economies have not been able to grow their way out of post-GFC debt levels. With rising debt balances and without income growth, the world has become even more sensitive to rising interest rates. Now, we recently saw this in the US. It didn't take much for the US to slow down, for the US economy to slow down after they put up interest rates only a little bit. So what it tells you is that because debt levels are so big in economies all over the world has become very sensitive to small changes in interest rates. Given growth headwinds continue to build for the global economy because of country-specific and geopolitical headwinds such as deleveraging in China, Brexit in Europe, or the US-driven trade war, investors now need to start factoring in what a potentially more permanent lower interest rate environment means for investing in Australia. It is worth noting that although Australia did not experience the same fallout from the financial crisis as many economies did globally, our debt levels have continued to increase at a pace greater than our income growth. And this also means Australia has now become very sensitive to any slowdown in the economy and has become very sensitive to movements in interest rates. This means the Reserve Bank will do what it takes to keep interest rates low until it deems the economy to be at full employment, or where inflation is going to be running above the Reserve Bank's target level. So this slide that I've put up here is very recent and highlights the position of the Reserve Bank of Australia. It is now making a statement that it is essentially willing to back unorthodox monetary policy, such as quantitative easing, to keep interest rates artificially low for a prolonged period of time. A paper released by the Reserve Bank for International Settlements, the Bank for International Settlements, this month made a formal assessment of unorthodox monetary policy tools. Their broad conclusion is that unorthodox monetary policy does indeed achieve the desired economic results of helping a recovery. Now, why is this conclusion so important? It's because the working group was headed by Australia's Reserve Bank Governor, Philip Lowe. In essence, he has now endorsed a global paper supporting quantitative easing. Not only does the paper cite that the policy has the desired impact on financial markets and the economy, but the paper was also very dismissive that it was not a problem for bank earnings. This is because they conclude that what banks may lose between what they lend at and what they borrow at in terms of their net interest spread, they are making money back elsewhere on a better loan loss experience. So lower interest rates means not as many bad debts. Gains on their securities, banks hold bonds. When interest rates fall, bond prices go up, so they make money from that. And also some of the growth they may see from fees and lending growth in general. However, the paper also noted that it was too early to tell whether low interest rates had a significant impact on banking systems. But regardless, it all points to one thing, and that is as long as economic growth remains low and remains below target, the Reserve Bank will want to keep interest rates as low for as long as possible. And it is not scared to use unorthodox methods of monetary policy to do this. This presents a challenge for our banking sector, because the more rates fall, the less ability they have to earn a spread between what they borrow at and what they lend at. So let's consider what falling interest rates means for the major Australian banks. The major Australian banks have about 1.6 trillion in customer deposits. We estimate of this, about 400 billion are paying either zero interest rates or close to zero interest rates. And when I think it's important to define what is close to zero interest rate, I define that as a deposit rate where if interest rates get cut by the Reserve Bank, banks will find it very hard to take that deposit rate down any further. So what this means is every time the Reserve Bank cuts interest rates 0.25%, it's going to cost the major banks about $1 billion in revenue, which is about 2.5% to 3% of current sector profits. So on a standalone basis, perhaps this does seem quite manageable. 3% is not a big number. However, you need to remember that interest rates are currently 0.75%. So if the Reserve Bank chooses to pursue a zero interest rate policy, you're looking at least 10% earnings downside for the sector. The other thing to remember is that every time rates get cut, the amount of deposits which approach zero gets bigger every time. So that might be 400 billion today, but post the next rate cut, maybe that moves to 500. So you can see that the effect actually becomes more pronounced the more rates fall. So we estimate the payout ratio of dividends for the major banks to be about 85% this year, 75 to 80% next year. But the implications are that if we enter a period of prolonged rate cuts, the downside to the earnings that could come from that means the dividends of the banks may be at risk. So if you think you're holding a bank today that's paying a yield of 5.5%, and you buy more banks as rates are getting cut for that yield, you may find in a couple of years that dividend is actually lower. As time goes on, we expect it's going to become harder, not easier, for banks to maintain their dividends. With a deteriorating outlook in bank fundamentals, it should mean bank share prices go down, right? Well, that's not what's happened. So let's look at an example here of Commonwealth Bank. And there are two key lines that I want to highlight on this chart. The orange line is analyst earnings estimates for Commonwealth Bank 2 years in advance. And that's shown over the last year. So over the last year, the analyst community in the Australian share market has been revising down its expectations for earnings for CBA's earnings outlook in 2 years' time. This is what we would deem to be a stock in negative earnings revision. The outlook, or the fundamental earnings for the company, is getting worse. The blue line is the multiple attached to the earnings, effectively the PE. So if you multiply those two lines together, you get the share price. And what this shows is, as the earnings outlook has been deteriorating, the market has been willing to pay more for Commonwealth Bank, not less. And the net result is that CBA's share price has actually increased from about $70 at the beginning of the year to about $80 today. Problem is, during this time, interest rates have fallen. And as Vince alluded to before, as interest rates approach zero, investors get increasingly desperate for yield. It doesn't matter that CBA's yield has gone from 6.3 to 5.5%. It's still 5.5% today. And investors have been attracted to that, and that's why the stock has re-rated. During this time, the All Ords has also increased from 62 to 6,800, which shows just how much of an influence lower interest rates have on all asset prices. So this is a challenge for fundamental investors like us. The outlook for investment opportunities in banks is probably worse today than it was a year ago. We now need to pay more for lower earnings. And the lower rates go, the more risk there is of a potential dividend cut. A low interest rate environment, and in particular a rate environment that is low because of central bank activity, is making it very hard to be a fundamental investor in banks right now. So let's consider the international experience. An economy with zero or even negative interest rates is not without precedent. As the chart here shows, there are now numerous countries which have pushed the boundaries on unorthodox monetary policy into the absolute unthinkable, charging banks for having deposits. We now have a situation in Switzerland where if a commercial bank has surplus deposits and puts it with its central bank, it will get back less money after a certain period of time. So how have bank stocks performed in these markets? Badly. This chart very clearly shows the damage that a zero or negative interest rate regime can do to share prices. Now, it's very important to understand that the share price decline is not just reflective of earnings cuts. It is also taking into account the multiple on the stock. And that, if you think back to the previous two charts that I showed you, it's that blue line on Commonwealth Bank, the multiple which the market wants to pay for the earnings today. So what we have happening offshore is actually the complete opposite of what's happening in Australia. Internationally, bank stocks where interest rates are headed towards zero are de-rating, and in Australia, they have re-rated. But the chart also shows another important aspect. It takes time for the market to recognise the deteriorating fundamental outlook. As fundamental investors that can foresee challenges that lie ahead for banks, it could mean we might not see the full impact on bank share prices for a couple of years. We are going to have to be patient. The market is not so efficient at pricing in a change in operating environment and will want to see tangible evidence of downgrades before share prices come under pressure. So we need to be prepared for the challenges that are growing in banks, and that is why we continue to remain cautious on investing in the space. Now, I think it's important to be clear that this does not mean there are not opportunities to invest in banks. But the opportunity to invest in banks is going to have to come from other areas outside of their core lending expertise, and that may be cost reduction strategies, technology opportunities, or superior customer product offerings. You may be familiar with some of the fintechs which have been pioneering opportunities in the Australian market, and they've been offering differentiated customer products. But this doesn't mean that major banks are not going to get involved. We think major banks could actually become a very important part of Australian financial services infrastructure in terms of being custodians for customer financial data. So we are looking to invest in banks that can deliver superior technology and cybersecurity offerings to their customers. Another chart to highlight on international experience is considering what the outlook is for net interest margins for Australian banks versus international comps. Now, broadly speaking, a net interest margin, as this chart shows, is the difference between what a bank is lending at and what they're borrowing at. So in Australia, that number is 1.96%. And as you can see, the further you go down to Japan, which has been in a zero interest rate environment for the longest, that margin is 0.89%. What this chart doesn't show, and which I'd like to highlight in the UK, is the difference between what banks are lending at today versus what's on their books at present. In a recent trip we did to the UK about 3 months ago, in a meeting with Lloyds, we learnt that the spread that they are making on their mortgages today is about 1%. That's almost half the spread on what they have on their existing books. So what we should expect to see is that that UK number will start to fall quite substantially in the coming 3 to 5 years. It will take time, but we know the direction is down, not up. And the Australian economy is probably not too far behind the UK economy in terms of the shape and nature of its banking system with regards to competition, litigation, and also increased regulation. The last point I'd like to make is that UK banks are trading on PEs of 7 times. Australian banks are trading on double that. And this is the valuation challenge that we face in Australia. So in summary, I'd like to just recap that low interest rates will create net interest margin pressure for the banks, and that is a revenue pressure headwind for the Australian banking system. It will force banks to think more carefully about their costs in order to support their earnings, and it may even see at some point some form of industry consolidation. The falling return on equity for the banks does mean that in the next sort of 2 to 3 years, we may start to see pressure on dividends for the major banks, because what we have seen internationally is quite bad experience. So when we consider investing in banks, we're taking into all these considerations to make sure we're putting capital to work prudently. Thank you for your time.
I've been told I've got 2 minutes. I'll just we'll walk through performance The last 12 months in particular has been quite poor for us. Again, I talked about the yield trade, the people chasing high multiple stocks. They want guaranteed dividends. And for us, our style is that we're quite disciplined about the fact that we won't pay for companies we don't feel that are trading below intrinsic value. And for the last 12 months in particular, that's been highlighted as we've been left behind a bit because of that. But to the point, the last month there was a bit better in performance from us. But I want to make sure you understand that we will stick to our discipline of we're a quality and value manager. We're looking for quality companies at reasonable prices. Okay, you need to look at reasonable prices. We don't want things at rock bottom prices. You have to wait a long time for that to happen. But most of the time we are investing actively for you. So when we get a good company with good management at a reasonable price, like a Flutter when we bought it about 9 months ago, where the prospects, the market are not willing to value, then we'll take a calculated risk and put that in the portfolio. At the moment, the allocation towards the 3 different assets we can have, cash, international and Australian equities. Australia at 71.2, global has been increasing. We have increased it more since this is as at September 30. We have increased a little bit more, and cash is lower at this point. Just lastly, I want to just cover off on, there's quite a few names on the screen. This is what's been added in the last 12 months and a lot actually in the last 3 months. As there's been some rotation in the market, it's thrown up a couple of opportunities. Unibal Rodamco, which is the merger between URW, Unibal and Westfield, happened 2 years ago. We now haven't owned the stock. It's derated substantially. It's come from about $14.50 down to about $9.60. That's when we started entering the position. It's on about 10 times PE. It pays about an 8.8% yield. Unfranked, because it is offshore earnings, but we quite like the management. We think they're quite robust. Look, it is a retail mall owner, and no one's going to the shops anymore, apparently. So our view is we've done some work on this. We've sent 2 of our portfolio managers went to Europe to kick the tyres. Let's see what they've got. And actually, we've come back a lot more confident now that the position's about 4% of the PEIC. It's one of our largest active weights now. Platinum's a more recent position, about 2 months ago. Again, everyone knows who Platinum Asset Management is. They're a global manager, paying about a 6.5% fully franked dividend yield, trading when we were buying about 13 times. Apparently, everyone thinks it's the end of active management. I don't tend to agree with that view, given what we do for a living. But I like that the team there, they're a very good management team, great portfolio managers. They are all about stock picking. They don't go with the crowd, and they look for idiosyncratic risks. Looking for companies which are risks. They take risks which are very specific to the company, not trying to find a theme, etc. Cube Logistics, many people might know it. It's a stevedore. We bought it because we think the market yet is still not valuing the Moorebank intermodal that's being built there, which is basically going to rail from Port Botany all the containers out to Moorebank to be split up there rather than... So they're taking about 1 million truck trips from Botany off the road. Now that's being developed. They're now signing up customers. We think the market still isn't valuing it correctly. Oz Minerals is a copper play. Copper hasn't done much of the last pretty much 12 months, 18 months. Oz Minerals, we took a reasonable position in it. Any sort of pickup in global activity again. Now everyone's worried about global activity slowing. Copper's the first thing that typically moves when activity actually starts to pick up. We think we're entering there at a reasonable price. We've got a valuation of about $11.50 on Oz Minerals. It's trading at about $9.30 at the moment. Noni B, it's a collection of loosely termed fashion brands, but we really like the management. We actually really like the management. We think they're one of the best, outside of Premier Investments, which is Solomon Lew's company, probably some of the best retailers in the country. They've invested well in their systems. It's trading on about 7 times PE with a very good balance sheet. They're actually still growing their business on a 7 times PE, and we're getting about a 5 to 7% yield because there's a chance of a particular upgrade in the dividend. GED Holdings, they own a couple of automotive brands, Ryco, Westfield. They own some water pump businesses. Again, we talk about opportunity. They downgraded about 3 months ago their earnings because running into the election, the economy was weakening quite a bit. People were quite worried. Got to about 11 times PE on about a 6.5% fully franked dividend yield. It's about 2% of the PEIC. We took advantage of that short-time mispricing. It's rebounded back up from $9.50 up to about $10.50 now. We still quite like it. I actually saw the management yesterday, the CEO and the CFO. Like what they're doing. I think it's a great Australian business with an ability to still grow about 4 or 5% a year and a pretty healthy dividend policy. So we're going to see dividend growth out of that stock. And lastly, which is a very new position, Link Administration. We haven't owned that for a while. That has had 3 profit warnings in the space of 12 months. It was a former darling stock. Everyone really liked it. At $8, you couldn't buy enough of it. Now it's trading at $5.50. No one wants to buy it. So that's when I tend to get a bit more interested. So about here, you're getting about a 4.5% dividend yield, about 16 times. We think this year's the year where the earnings will bottom and start to grow again. It's got a business in the UK that they just bought about 18 months ago where we think there's a lot of negativity around Brexit, so that's sort of being implied in the stock price as well. That's when you want to be buying these things, when there's significant negativity, because things will mean revert at some point. And globally, there's a company on the right-hand side, Ferguson. They're a plumbing supply business in the US. 90% of its business is in the US. It's listed in the UK though. Trading on about 13.5 times PE. It's growing its earnings by about 8 to 9% a year. So for us, that sort of a business, it's equivalent to a Reece in Australia. Everyone knows who Reece is. We found this one internationally. We think it's a great business, great management team, and they've actually announced, even though it's listed in the UK, they've announced they're changing their domicile to North America, where a lot of their peers trade on about 18 to 20 times. So we think we're going to get a multiple re-rate out of Ferguson, but also growing earnings stream as well.